Why did the panic of 1907 lead to bank runs? Imagine waking up one morning and hearing that a major bank might collapse. That fear spreads fast, and suddenly everyone rushes to withdraw their money. This is exactly what happened during the panic of 1907. It was a time when trust in the financial system was fragile, and a single event could cause chaos. The panic started because a failed attempt to corner the market on United Copper Company shares caused big losses for speculators and the banks that financed them. When these banks showed signs of trouble, depositors got scared they might lose their savings. They rushed to take out their money, fearing the banks would fail. Without a central bank or a safety net, banks couldn't easily get cash to meet these sudden demands. This made the situation worse because even healthy banks faced liquidity shortages. The panic spread quickly from a few banks involved in the copper speculation to many others across New York City, and then nationwide. The interconnectedness of banks meant trouble at one place raised doubts about others, causing a domino effect. People started hoarding cash and selling off securities, which made the financial system even more unstable. The economic environment before the panic was already tense. Stock market speculation was high, interest rates had risen sharply, and international credit was tight. Countries faced banking failures and gold reserves were dropping, making the system more vulnerable. The crisis was eventually eased by private financiers like J.P. Morgan, who organized a group of banks to provide emergency funds. This helped restore some confidence, but the event exposed how fragile the banking system was. It showed that without a central bank to step in during crises, the entire system could collapse quickly. The panic of 1907 led to calls for reform, which eventually resulted in the creation of the Federal Reserve System in 1913. This new central bank was meant to act as a lender of last resort and prevent future bank runs. So, the panic caused bank runs because a failed speculative scheme shook confidence in key banks. Without a safety net, depositors feared losing their money and rushed to withdraw funds. The interconnectedness of banks and existing economic pressures made the panic spread rapidly. This episode highlights how trust in banking can vanish overnight and why having a system to provide emergency liquidity is so important.